Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Chris Sugden. He's a managing partner over at Edison Partners, and we're going to look at Fintech investing opportunities. Thank you very much for joining us at MarketSite today.
Thanks for having me, Jill.
And let's review macro trends in the private equity and venture capital world. Where are the money flows and what are the valuations like these days?
It's busy for sure. Money flows, you've seen a lending run up, if you will, for the last few years. That's kind of calming down. Now you're seeing some aggregation around bundling of offerings to consumers. So let's say a lending platform, a credit platform, a banking platform, all coming together. So we went through sort of an unbundling meets rebundling moment. And then today, of course, you saw Acorns raise a big round from BlackRock and others. The robo-advisor world is still seeing a lot of interest. So that's on the consumer and kind of financial technology for the consumer and investing space. On the capital market space, we're going through an interesting revisit, if you will, to some of the transparency, some of the capabilities around execution. So venue analysis, those sort of trends. So I think capital markets, lending, credit are all pretty interesting markets right now.
So where's direct investing for the moment?
So I think we're talking there about, from a limited partner perspective, folks who used to invest only in funds now want to get into deals with us, right? So partnering with us into direct deals to make their money work a little harder for them. It's a phenomenon that's really come on in the last couple of years, particularly the last 3 or 4 years, where you're seeing most limited partners set up shop to invest right alongside us.
What about M&A and consolidation within all the different sectors that we cover?
Yeah, it's a good time to be a seller. You asked about valuations, the first question. I didn't get to that one. And the bottom line is, it's certainly more of a seller's market than a buyer's market. The public markets run up has helped, but I actually think right now you're seeing private company premiums versus public, which you just don't usually see. Wouldn't use the word bubble, but I'd say we have bubble-like tendencies because people want to get paid 2 and 3 years ahead, which in the normal markets, you might say it's a 12-month ahead sort of an investment valuation environment.
Well, you're passionate about investing in underserved markets, so basically anything outside
of
Silicon Valley, and I think that's really interesting. What makes it for sound investing when you're looking to choose winning emerging companies?
Great question. One of the biggest ones is a willingness to sort of know what you don't know. Founders and entrepreneurs have to be contrarians. When everyone's telling them no, they can't do it. They have to be willing to believe they can. But then you also get to a point when you take money from institutional investors like us, there's a lot of things you don't know. And we like to say, on-the-job training and making mistakes you don't need to make is not a good idea. So we're trying to, if you will, partner with the companies that and CEOs who actually want more than just the capital. Don't just drop off the dough and come at board meetings, but actually show up in between board meetings, help build the company, help build value, particularly around sales and marketing, product management, areas where entrepreneurs just aren't naturally gifted, if you will.
Right, I love that. Know what you know what you don't know. I think that totally drives success. But to wrap up, what are monitoring fees and why do VC and PE firms charge them?
Boy, it's a good question. It's something that I'm careful of because it sounds like I'm biting my own hand that feeds me in a way. We don't charge them to our companies. Our value add platform is part of the deal. You take dilution from us and we take your equity, if you will. You take our money and that's the deal and we help you. It's something that seems to be at the higher end of the market where buyout firms tend to charge their portfolio companies a monitoring or a transaction fee, a fee to help the companies. I sort of questioned it. I've asked limited partners what they think about it. I think generally speaking, it's not all that popular. I think there's going to be some pushback. In up markets, everyone wants in this asset class, so there tends to be less of that. In down markets, it tends to be a little more pressure on those fees.
All right, well, thank you very much. Very interesting insight.
Thanks for having me.
All right, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.